While everyone's obsessing over the TSX daily moves, professional Canadian investors are quietly watching three numbers that actually predict what's coming next for our economy. These aren't complicated. You don't need an economics degree. But these three indicators warned me about the tariff impact, the housing shutdown, and every major shift in the economic market in Canada over the past year, often weeks before most people saw it coming. Let me show you exactly what I watch and why it matters to your money. Welcome back to KP Money Talks, and today I'm revealing the three economic indicators I check every week to understand where Canada's economy is heading. These signals help me make decisions about everything: when to be aggressive with the investments, when to get defensive, when to hold cash in high interest savings, and when opportunities are emerging. If you want to stop reacting to headlines and start anticipating Canadian market moves, hit the subscribe button and let's get into it. The very first indicator I watch religiously is Canada's Labour Force Survey, released by Statistics Canada on the first Friday of every month at 8:30 a.m. Eastern. What it measures, you might ask? This monthly report tracks employment, unemployment, wage growth, and participation rates across Canada. It's the most comprehensive snapshot of our labor market health. Why does it matter? Because employment drives everything in Canada. When people have jobs, they spend money, pay mortgages, and keep the economy humming. When unemployment rises, consumer spending drops, mortgage defaults increase, and the entire economy slows. What I am looking for: I track four key numbers. Unemployment rates, currently at 6.8% as of February 2026, elevated from the pre-pandemic norms of 5.5 to 6%. Anything above 7% signals economic stress. Employment change. We gained about 190,000 jobs from August to December 2025, but growth has been uneven. I watch for sustained monthly losses, and that's a red flag. Youth unemployment. This is particularly high right now despite recent improvements. Young workers are the canary in the coal mines. They get hit first when the economy weakens. Job vacancies. These have fallen to their lowest level since October 2017. Fewer openings mean employers are cautious, signaling economic uncertainty. Here's the 2026 context. Labor market slack remains elevated. We're in a state of excess supply, more workers than jobs. This is keeping wage growth modest and putting downward pressure on inflation. Sectors tied to US trade have seen employment stay subdued after a sharp decline in early 2025 due to tariffs. Manufacturing and export-oriented industries are struggling. Why this is powerful? Employment data is a leading indicator that turns before a broader economy. When unemployment starts climbing rapidly, recession risk increases sharply. Where to find it? Statistics Canada released this data on the first Friday of every month. Google Canada unemployment rate or visit StatCan's website. Set a calendar reminder, it's very important. This is my early warning system for Canadian economic trouble. The second indicator I track is the Bank of Canada's core inflation measures, specifically CPI trim and CPI median, released by Statistics Canada monthly around the third week. What it measures? While everyone focuses on headline CPI, the Bank of Canada actually looks more closely at core inflation, which strips out volatile components like food and energy to show underlying price pressures. CPI trim removes the most extreme price changes each month. CPI median shows the price change at the middle of the distribution. The Bank of Canada averages these two measures to gauge underlying inflations. The Bank of Canada's target. The BOC's mandate is to keep inflation at 2%, which is within a range of 1 to 3%. Core inflation tells them whether the price pressure is increasing or easing. What I am looking for. As of December 2025, core inflation was around 2.5%, down from 3% in October. Headline CPI was 2.4% in December 2025, but CPI excluding indirect taxes eased to 2.5%. Here's my framework. Core inflation at 2% or below, which means Goldilocks scenario, economy is stable. Core inflation 2.5% to 3%, elevated but trending down. Bank of Canada watches closely. Core inflation above 3%, red flag. Bank of Canada may need to raise rates. Core inflation below 1.5%, deflation risk, economy may be too weak. Why this matters? Core inflation drives Bank of Canada interest rates decisions. If core inflation stays elevated, the BOC won't cut rates further, or even hike it. If it drops below target, more cuts are possible. Interest rates affect the following. The 2026 context. Core inflation has eased significantly from the 2022 to 2023 highs, and the Bank of Canada has cut rates to 2.25%. But they're signaling they're done cutting for now. The tariff-driven supply chain reconfiguration could put some upwards pressure on prices. But excess supply in the economy is offsetting this. Core inflation is expected to stay close to 2.5% over 2026. I watch this monthly to anticipate whether the Bank of Canada might surprise with rate changes. Where to find it? Well, Statistics Canada publishes CPI data monthly. Bookmark the Bank of Canada's website and check their indicators of capacity and inflation pressure. The page is updated after every rate announcement. The third indicator I monitor is Canada's GDP growth and the Bank of Canada's estimate of the output gap. What it measures. GDP measures the total value of goods and services provided in Canada. It's the broadest measure of economic activity. The output gap compares actual GDP to potential GDP. A negative output gap means excess supply, the economy is underperforming. Why this matters? GDP growth tells you whether the Canadian economy is expanding or contracting. The output gap tells you how much slack exists, and that affects inflation, interest rates, and employment. What I am looking for. Statistics Canada released monthly GDP estimates around the end of the following month and comprehensive quarterly reports. Here's the current situation in 2026. GDP growth. Canada's GDP is forecast to grow just 1.1% in 2026 and 1.5% in 2027. That's well below our historical average of 2 to 2.5%. For context, 2025 GDP grew only 1.7%, essentially flat on a per-person basis that you can account for population growth. The output gap. The Bank of Canada estimates the output gap of Q4 2025 was in the range of 1.5% to 0.5%. That means the economy is operating 1 to 1.5% below potential. This excess supply is keeping inflation in check, but it also means weak job growth and stagnant incomes. What this means for investors. Weak GDP growth indicates the following. While strong GDP growth means the exact opposite. Where to find it? Statistics Canada releases monthly GDP estimates. The Bank of Canada's Monetary Policy Report, which is quarterly, provides detailed output gap analysis and forecasts. I check this monthly when StatCan releases data, and I study the Bank of Canada's quarterly report religiously. Here's the key. I don't look at these indicators in isolation. I use them together to create a micro picture of Canada's economy. Green light. Unemployment below 6%, core inflation steady at 2%, and GDP growth above 2%. This is when I'm fully invested in Canadian equities. The economy is healthy and it's time to be aggressive. Yellow light, to be cautious. Unemployment 6.5% to 7%, core inflation 2.5%, and GDP growth 1 to 1.5%. This is where Canada is in early 2026. I maintain positions, but I'm selective. I favor quality companies, hold more cash in HISAs earning 4%, and wait for clarity. Red light and defensive. Unemployment above 7.5%, core inflation spiking above 3.5% or falling below 1%, and GDP growth is negative. This is when I reduce Canadian equity exposure, focus on defensive sectors, and consider bonds, and protect my capital. Right now, we're firmly in a yellow territory. Employment is soft, core inflation is easing, and GDP growth is anemic. I'm neither panicking, but I am also not getting aggressive with Canadian investment either. I'm watching and waiting. There you have it, the 3 Canadian economic indicators I watch every week: employment data, core inflation, and GDP growth and output gap. These won't make you a day trader, but they'll help you understand where Canada's economy is headed and make smarter, long-term decisions. Set up a routine. Bookmark Statistics Canada and Bank of Canada websites. Check them on schedule and let the data guide your investment decisions. If this is valuable, smash that like button and subscribe for more Canadian economic analysis and investing strategies. Leave a comment below, and thank you for watching.